Housing headlines often describe the market as if it moves in one direction. Prices are rising. Prices are falling. Demand is weakening. But two cities can face the same economic conditions and move in completely different ways. In one market, prices hold steady. In another, activity slows sharply. That difference isn't random. It's structural. National housing data aggregates thousands of local markets into a single narrative. Interest rates, inflation, and economic conditions affect all regions at the same time. Yet housing outcomes vary widely across locations. Some markets remain tight, while others soften. Some see stable pricing, while others experience longer selling timelines. This divergence reflects the local nature of real estate markets. Understanding how national forces interact with local conditions explains why housing does not move uniformly. Housing is often discussed as if it were a single national market. National price indices and economic reports reinforce this view by presenting average trends across broad regions. However, these aggregates mask significant variation. Each local market operates with its own supply constraints, demand drivers, and pricing dynamics. A national trend represents the average of many different conditions, not a uniform experience. This distinction is important because market participants do not transact at the national level. They buy and sell within specific neighborhoods and regions. As a result, local conditions determine outcomes, even when national narratives suggest a single direction. National headlines may suggest a unified market, but housing outcomes diverge because local conditions determine how those broader forces are experienced. Housing supply is shaped by local factors. Zoning regulations, land availability, infrastructure, and development policies vary by location. Some regions allow rapid expansion through new construction. Others face significant constraints due to limited land, regulatory barriers, or geographic boundaries. Construction pipelines also differ. Markets with active development can respond more quickly to demand changes, while constrained markets remain supply limited for extended periods. These differences create uneven supply conditions across regions. Even under identical national economic conditions, one market may experience tight inventory while another sees expanding listings. Supply variation is a key reason housing markets diverge. Demand in housing is influenced by local economic conditions. Employment opportunities, industry composition, income levels, and population trends all shape housing demand within a region. Markets with strong job growth and population inflows tend to sustain higher demand. Areas with slower economic activity may experience reduced buyer participation. Migration patterns also play a role. Shifts in population between regions can increase demand in some markets while reducing it in others. Because these demand drivers differ locally, housing markets respond differently to the same national conditions. This variation means that demand is not uniform, and price pressure will vary accordingly. Housing prices are determined through comparable sales. Each property is valued relative to recent transactions within the same neighborhood or area. There is no centralized national pricing mechanism. Because pricing is localized, national trends filter into markets through local comparable sales rather than direct adjustment. This creates micro-market dynamics where even nearby neighborhoods can behave differently. Price discovery therefore occurs at a granular level, reinforcing local variation. National factors such as interest rates influence all housing markets. However, their impact is mediated by local supply and demand conditions. In markets with tight inventory, rising rates may slow activity without significantly reducing prices. In markets with expanding supply, the same rate increase may produce greater downward pressure. The interaction between national forces and local conditions determines outcomes. This explains why housing markets can move in different directions, even when exposed to the same macroeconomic environment. For owners, pricing outcomes depend more on local market conditions than on national narratives. Understanding neighborhood-level supply and demand is critical when evaluating selling conditions. For renters and buyers, market conditions vary significantly by location. Availability, pricing, and negotiation dynamics differ across regions even under the same economic backdrop. For investors, local analysis is essential. National trends provide context, but investment decisions depend on specific market conditions. For the broader market, housing does not move uniformly. National trends influence direction, but local conditions determine magnitude and timing. Housing is not a single market. It is a collection of local markets shaped by distinct supply and demand dynamics. National trends provide context, but local conditions determine outcomes. Understanding this structure explains why housing behaves differently across regions. Subscribe for market insights. Link in description for additional analysis.